Greggs is a UK company, approximately 1.7 billion sterling market capitalization, with an EV of just over 2 billion. The company was founded in 1939, so just before World War II, by a chap called John Gregg. It was originally just a business selling loaves of bread and other baked goods door to door in Tyneside, which is sort of the region in the northeast of the UK around Newcastle. They opened their first store, I believe, and it was in 1951, and the business was handed over to his son Ian Gregg, who rapidly expanded the format over the subsequent, couple of decades, uh, to the extent that now they're one of the largest QSR restaurant chains in the UK. Sort of they have a unique format which we'll talk about, but 2,658 stores only in the United Kingdom, predominantly in the north of the country still, with higher densities there. The company is conservatively financed, so including leases, they have net debt to EBITDA of 1.2 times, but their term debt, which is in the form of a revolver, is only 35 million sterling today. So basically, no term debt on the balance sheet, and they earned just shy of 150 million sterling of income last year. It's been a great success story in the UK. So if you look at the 20-year track record of the business that you see there on the right, they've shown consistent growth with, the notable exception obviously being COVID. But they've grown earnings at 9.4% a year. Shareholders have compounded at 14%, and that's all been done with healthy returns on capital, which has allowed them to pay, consistent and growing dividends over time. The market structure, before we get into the business itself, the food to go market overall is somewhat fragmented, as you can imagine. Overall, eating out in the UK will grow around GDP, around 1.5%. Within that, food to go specialists like Greggs have been the consistent share gainers. Formats like pubs, which are still meaningful in the UK, around a quarter of the market, have consistently lost share, and service-led restaurants, so white cloth restaurants, have sort of lost share as well over time. So the food to go market, in which Greggs is really a fairly dominant player, is more likely to grow in the 3 to 4% range. And you can see that, Greggs has been a share gainer over the past 5 years or so, from 4% of the overall market to 4.7%. Now that's largely been through store growth. Other notable share gainers have actually been some of the supermarkets in the UK, so the likes of Tesco and Sainsbury's have really appealed to sort of the value conscious consumer. But Greggs is able to offer what we feel to be a better product quality, more fresh, but with a only marginally higher price point. The business model is quite unique, insofar as they own and manage the majority of their stores. Around three-quarters of their stores are owned and managed, only a quarter are franchised, and their franchise partners are not typically independent operators. A lot of it is sort of gas station chains and the likes are more professional in nature. They also, importantly, control all the manufacturing and logistics. And in a country like the UK, which is relatively dense from a population concentration perspective, and with the company being solely focused on that market, that vertical integration is an incredibly important element of the business and has allowed them to drive down their cost to serve customers consistently over time. So you can see in the chart on the bottom right there, supply chain OPEX as a percentage of sales, having peaked at just shy of 19% in 2013, has consistently trended down, and as of 2023 was just shy of 14%. So it's 4.5%, 5% improvement in the cost base. But in an industry where, the market typically works off, let's say, high single digit EBIT margins, that 5% truly matters. And it's a source of clear and enduring competitive advantage relative to peers who don't have that quality to them. Now, we use a language which we call symbiotic loops. So businesses which, through scale, share those economies of scale with the customer, which leads to a more durable franchise. And in that way, Greg's really epitomizes that idea. And you can see that also in relation to sort of how their margin structure differs to peers. Their gross profit margin is just above 60%. So the incremental value of a sale on that predominantly fixed cost base that they have is phenomenal. And again, creates that virtuous cycle that we call a symbiotic loop. So just here, you've got some data on how they share that with the customer. So on the top right is our survey data looking at the price of a few key items of Greg's relative to some peers that we've highlighted. And as you can see, Greg's is routinely one of the lowest cost options for customers. They have a rather iconic product in the UK, which is a sausage roll. Think of it like a corn dog with pastry around it. It's incredibly iconic in this country and goes for, on average, around £1.30 nationwide. Pricing differs a little, so if you were to come visit London, you might see prices around £1.50. But it's an incredibly good value and I personally think quite tasty option for customers. That's our data. It's supported by data from YouGov, which sort of shows again that strength of the brand. It is the most loved UK brand overall across any sector. As a UK business, it's really got a share of mind, so to speak. But where they really differentiate is in terms of value there. So it is known as a cheap, good product for by UK customers. If you look at the business and what drives incremental growth for the company and where the returns have really come from, it's a combination of things. They outlined a plan in a capital markets day in 2021, which was a 5-year plan. And you can see on the right here, their plan was to grow from, around 2,200 stores nationwide in 2021 to around 2,900 for 2026. They're broadly on target for that, opening around 150 net new stores a year. But there are some other important drivers for the business too. Those being evening trade, which is around 9% of the company sales. That's post 4 p.m. Delivery, which is a relatively nascent but growing part of the business, and they've partnered up with the key food delivery companies in the UK, being Uber Eats and Deliveroo and Just Eat. And then what we feel is an underappreciated part of the business, which is the B2B business. That includes their franchise operations, but also key partnerships with supermarket chains in the UK, being Iceland and Tesco in particular. So you can see overall, relative to the plans that they outlined in 2021, they've done quite well on the revenue front, broadly hitting their targets. Similarly with evening and delivery, although delivery they've fallen somewhat short, but it's relatively small in the grand scheme of things. Where they've really struggled and where they've gone way above budget is in their capital spending plans. So right at the bottom of that table there, you can see that they've spent significantly more than they'd originally outlined in CapEx. And that's one of the key areas we'll discuss sort of later in the presentation. Um, the valuation right now is incredibly low relative to historical standards. On a trailing 12-month basis, the shares are on 11, 12 times PE. The dividend yield is approaching 5%. You can see that that's sort of the lowest valuation we've seen since around 2014 for the business, and that's on EV to sales you've got there. Sort of COVID clearly distorted the earnings a little during that period. But you can also see that the shares have declined by around 50% from their peak in 2022. Now, there are a few reasons for that, and we'll touch on all of them. One is the broad UK macro context. To be blunt, the UK is in sort of stagflation, relatively low nominal growth and relatively high inflation. That's manifested in increased costs, both on operating costs and capital. And because of that, and sort of lack of affordability, more broadly in the UK, you've seen volumes decline and like-for-likes decline somewhat over the past year or two. And on top of that, it's been exacerbated, maybe a bit of a tail wagging the dog. But various people, including the Financial Times, have speculated that we've reached what they termed peak Gregs, i.e., the number of stores in the UK has reached saturation. Uh, in almost all of those cases, we think those concerns are more short-term in nature, but the reality is quite simple. It's led to declining cash flows, declining margins, and declining like-for-likes over the past year or two. And we believe that that is about to revert. And that's really the core of the thesis. It's a good business that has faced temporary headwinds and we think is about to enter into a better phase.